Good morning and welcome to this Monday, February 7th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, I was looking at futures. They were a little bit down last night, then they came back. They were a little bit up this morning. Just giving you a quick, over at stock charts, I'll just give you a quick take on the spider pre-market. That'll bring us up to date. The spider up about 0.25%. The QQQ is actually up about 0.3%. So that's your NASDAQ 100. And the diamonds right now up about 0.15%. So looks like we'll get off to a little bit of a higher start this morning. And that comes on the heels of some selling at the end of the day on Friday. So we'll see whether or not we can hold, some key areas of support, and also be looking at some overhead resistance. I think lines have been drawn now. I think with VIX hitting 39 and the S&P 500 dropping all the way down to, was it 4220 or so? But I'm still looking at a closing basis, that 4,300 level. So I think 4,300 is what we need to watch to the downside. And I believe the highs that we saw this past week, getting back up to close to that 4,600 level. And then the 50-day moving average also coming in at about that. I think it's just over 4,600, around 4,630 or so. Actually 4,620. I just pulled it up. I think 4,600, 4,620 to the upside, 4,300 to the downside. I think we've kind of established now the range. I mean, in this downtrend. Now, if we can get back through that 4,620, and we'll talk about that in a couple minutes, but if we get through 4,620, then to me, it starts to look a little bit more like sideways consolidation. Doesn't mean we're not going to go down further. It just means things are just going to get more complicated. It's, if you're in a downtrend and you can see the tops and you can, expect that we're going to break through the lows, and it happens, that's a little bit more easily predictable. But once you start taking out what I think is the right shoulder and you get back up above moving averages, then you start getting a little bit more bullish slant. But then depending on what's happening underneath the surface, there's lots of things that you have to look at. Just as I always say, it's like a big puzzle with lots of pieces. And those who have a bullish bias tend to look only at a couple of pieces that look bullish. And those with a bearish bias tend to only look at pieces that look bearish. And I'm a self-admitted bull because I do study history, and the market goes up a lot more than it goes down. So I'm going to lean that way, but doesn't mean I'm going to stay bullish. And hopefully, as you've seen the last 5 weeks or so, I think taking a bearish, cautious stance from time to time, not always, not every time the market goes down, not every time you hear it on CNBC, but there are times when you do need to be cautious, and that's based on what the charts are telling us, not what anyone else is telling us. Anyway, let me take you over to Earnings Beats. We'll get this party started. Had a great event on Saturday, by the way. Took a look at the January effect, and if you were unable to make that, that was a free event on Saturday, but if you're unable to make it, we do have recording available. If you go to earningsbeats.com, just go to our homepage and you come down. We started this February educational series and added 3 unique events this month. The first one, like I mentioned, the February effect, that is a free event, or was a free event, and the recording will be available for free. Anyone can watch it. Essentially what we did there with the January effect is we were, and by the way, right here, if you scroll down, you can click for the recording. Like I said, it's free. Anybody can go in and take a look at it. But I always find it very fascinating, the connection, the correlation between performance in January and performance in the balance of the year. And it's not just, this year, that year, it's the average. What I do is I break down the January performance into 4 quadrants, the top quadrant being the best Januaries on record. Whatever years they are, they go into that top quadrant. I looked at the last 72 years. So if you divide 72 by 4, you get 18 years. So there's going to be 18 years in each quadrant showing performances in January, the best performances in the top quadrant, The worst performances in the fourth quadrant, and then the rest, the second and third, filled out in order of performance, January performance. And it's not so much, I mean, obviously we know come February where you fit, which quadrant you fit into. But the interesting part is the rest of the year, starting on February 1st, if you are in a good January or one of the best Januaries in that top quadrant, you have a much better chance to have a significant return the balance of the year. So I'm not going to sit here and explain over and over again what we already went over on Saturday, but if you're interested in this, I find it fascinating. It's just another one of those puzzle pieces that tells me we need to be careful in 2022 because of the last 73 years, including this January, of the last 73 years, I believe January 2022 ranked 66th, maybe it was 67th out of 73 years. So there are obviously, it's going to be in the bottom quadrant. So just lower your expectations. That's kind of the theme that we talked about on Saturday. Lower your expectations based on that. And by the way, the NASDAQ, which goes back to 1971, has now got, I think, 43 years, or maybe, no, 42 years of this data. And January 2022, of those 42 years, January 2022 was 41st. It only beat 1 year, which I think maybe it was 2008. I'd have to go back and look at it, but I think it was 2008. Anyway, you got to know what the market tends to do. It's not a guarantee. Nothing's a guarantee. I'd really try to stress that all the time. Yeah, but Tom, you said, well, I'm giving you history. I'm giving you facts. Sometimes I'm just giving you my opinion. Nothing is a guarantee. So you've got to just take this for what it's worth. It's just information. It's knowledge that I think gives you an advantage over everyone else in the market. If you have this knowledge, it's better than not having the knowledge. And then what you do with it is up to you. However you decide, to position your portfolios, whether you're nervous and you're cautious, and you just, hey, I'm just going to go into cash. That's fine. You might say, well, I'm not really worried about it. I think market longer term is good. I'm just going to stick with the market. That's fine. Your choice. That's the beauty of the market. Everybody has to make their own choice. That's what makes the market go round. Anyway, we got a couple more events coming up, and I think this one Saturday is going to be awesome. I started working on that a little bit over the weekend. This is going to really provide you some great knowledge of, I keep talking about these cyclical bear markets, not a secular bear market. It's a cyclical bear market. What's the difference? I mean, break it down. What's the anatomy of a cyclical bear market? What should we be looking for? What are the averages? What is the worst one? What's the, maybe the one that wasn't quite so bad? What do they look like? All these things we're going to be talking about on Saturday. Now, this is for our members at Earnings Beats, but you can come in with a 30-day free trial. So session 2, which is this Saturday, cyclical bear market. And by the way, just like last Saturdays, it'll be recorded. So if you've got plans on Saturday and you want to look at it some other time, not a problem. We'll have it recorded. The third session, the next Saturday after that, Saturday, February 19th, I'm going to look at the most overlooked growth stocks. I think there are some stocks with inflation out there, higher inflation prospects, higher interest rate prospects. Growth stocks are just under siege. I mean, they have been getting crushed. And probably, until we get a bottom put in, I don't see an end in sight in the near term. I do think the more pressure is going to be on the growth stocks. Stock market will look ahead, so it'll start to turn before we think it should. That's why we got to be following the charts. But I do think we're probably still looking at some difficulty for growth stocks over the next couple months. Anyway, they're all getting thrown out. The question is, which ones should we really be focusing on? Which ones are showing signs, even though their prices are going lower, which ones are showing signs of being accumulated? All of these things we're going to be talking about. I'm going to kind of let things play out here over the next couple of weeks, get through earnings season, and then talk about the most overlooked growth stocks. So I think these 3 events just kind of line up perfectly. The first one kind of giving us the warning that, hey, things may not be so great this year. The second one, because I already believe that we've started a cyclical bear market. The second one will tell us a little bit more about what to expect, what prior cyclical bear markets have looked like. And then we get into the most overlooked growth stocks, which can set us up for when we spot the bottom hopefully I'll be able to spot the bottom like I spotted it at the top. I don't know. Sometimes the market is easier, and some of the signs are much easier to see. Other times the signs are not quite so easy. And sometimes you're reacting to something that's already happened. We'll see. Anyway, at the bottom of this form, you can see you can sign up for our membership. It's a 30-day free trial. So after 30 days, and we'll let you know when your 30 days is up. We'll send you an email. We're not going to, hope you don't see anything. And on the 31st day, zap you for 147. That's not what we're all about at Earnings Beats. If you're not enjoying the service, we don't want you to pay. We don't want you to be a member. I think you'll enjoy it. Anyhow, you can sign up here on this form. We've got it down here at the bottom, and we'd love to have you and come join us for those next two events. All right, let's see what happened on. I'm just going to go down. I didn't set up all the charts. I just wanted to go down and look at some of the key indices and what happened. You can see the Dow finished down on Friday, and if you pull it up, we had gone. It was kind of a mixed bag Friday on the Dow. You can see we started off weak, really came back strong. It looked like things were going to be fine, and then we had this close where we lost 200 points into the close, literally in the last 20 or 30 minutes. So that took us negative. The S&P 500 up 23, but again, if we look at the chart, very similar. We got back up close to 4540. Remember that recent high was near 4600, so we weren't that far. If we had a big surge into the close, we'd been right on the verge of a pretty key potential breakout near the 50-day moving average. Instead, we went the other way, lost 40 points, almost 1% on the S&P in the last half hour. NASDAQ was having a huge day. That fell 100 points, 125 points, something like that, just the last 30, 45 minutes. So it was just one of those days. Little rough in the early part, really strong throughout the middle of the day, looked great, and then kind of like pulled the carpet out from under us at the end of the day. So we'll have to see what happens. Today. I'm going to just give you a quick update on the spider to see where we are in pre-market. Still right around that up 1/4 of 1% level. So anyhow, I mean, looking at I don't know, you can look at the S&P 5 or S&P 600. We did finish, I think, slightly higher here, or right around break even. Had the down move in the morning, had the strong during the day, came back down at the end of the day. Same kind of thing happened on the mid caps, down early, nice big rally, and then very weak close. The VIX, and in fact, maybe what I'll do is pull up this chart just as a final market recap from Friday. The volatility index, this was the Monday. I think it was Monday the 24th, right at about here. And let me pull up the S&P on the downside. Let's do a 15-minute chart of the VIX, and down on the bottom, I'll put the S&P 500. And then let's go with this. All right. So here's the VIX. This was the VIX spiking in the morning, right after 10 o'clock, right here. The VIX had hit 38. The S&P 500 was down to 4,300, which was the key support. Literally almost at that moment, I sent an email out to our members and said, VIX is near 40, 38. This is historically a very high level, and a level where we normally begin to see the market bounce. Well, after that email went out, probably 30 minutes later, you can see we took one more move, maybe 2 hours later. We did move up one more time in the VIX to 39, and we went all the way down to that 4220 area, and that was the bottom. That's the capitulation. When you start talking about capitulation, you look at the volume on the selling, but you also can look at the VIX. That's capitulation in terms of fear. And anytime we get into the 30s, I start looking for it. When you get up close to 40, there's not many times that we have seen the VIX go into the 40s. You're really talking about an extreme. We got to 39. That's a pretty big number. And you can see that mark the bottom. We haven't gone back down there. That's the beauty of panicked sell-offs, is that they tend to mark bottoms in a secular bull market where we just have, a quick sell-off like we did with the pandemic, where it was just a 4-week thing. That move up, creates a bottom that we may never see again. Now this one, because of the signs that I think we're going to have an extended period of selling, I think, yeah, we may not go back down to, or maybe not go back up to 39 on the VIX, but I do believe we're going to go back down below 4,300 and eventually I think into the 3,000s. Just my opinion. I could be wrong. I don't think it's 100% guarantee. I think it may be, if we get back up through 4,600, I think at that point, maybe it turns to 50-50. But as long as we stay below 4,600, I think the odds are maybe 60-40. And if we go back down below 4,300 and close below 4,300, I would say I'd be like 90%. I'd say 90-10 as far as I'm concerned, that we would go back below 4,000. So it's all about probabilities. Right now, the market to me looks weak. I think we still have better than a 50-50 shot that we go below 4,300, which eventually takes us down into the 3,000s. All right, let's keep moving on here. 10-year Treasury yield. You can see, let me get the latest here. Still just kind of flat, down 1 basis point, 1.92%. Broke out last week. If we go back and we looked, I'm not going to pull it up, but if we look back a couple of years, few years, I think it was back in 2019 that the VIX or the 10-year Treasury yield had moved up to about 195 to 197. Now we're at 192. So we're right up against some pretty big resistance on the yield. I suspect we're going to go through that. I think it's going to spook the market. It may coincide with the CPI report that we have coming up this 10th, Thursday. So Thursday morning, double check me on that, but I'm pretty sure it's Thursday morning that we have the latest CPI data. You're going to see that annual core rate jump again. Almost, I'm not going to say it's a guarantee, but it's almost a guarantee. I think in order for it not to jump, we're going to need to see the CPI come in this month at about 0.0. And the expectation is much higher than that. So I believe we're going to see a higher core CPI and most likely a higher headline number, annual rate. And that's just going to continue the talk about inflation, the higher rates, blah, blah, blah. And that's going to continue to keep pressure on the market, whether we like it or not. Now down here underneath the yield, I've got the financials relative to the S&P. You can see generally when the yield's coming down, financials struggle on a relative basis, yields going up, financials good, yields coming down, financials bad, yields going up, financials good. That's the normal thing that we watch. Well, the same thing happens with industrials normally. You can see the moves up here, back here in the yield move. We saw industrials move up. And down here on the bottom, we saw transports move up. These are relative charts. Industrials outperform the S&P 500 when yields are rising. Transports outperform the S&P 500 when yields are rising. Why? Well, folks normally are getting out of bonds when the economy is strengthening, because usually rates go up, value of bonds goes down, and earnings of S&P 500 companies go up. So you're going to lose value sitting in bonds and you're going to make money in stocks. That's why people sell bonds and get into stocks. And when they sell bonds, the yields go up. It's always an inverse connection, a correlation between the price of bonds and the yields. So when the yields are rising, folks are selling bonds. Normally, when that is occurring, transportation stocks are doing well. The economy is expected to strengthen. Industrials, which house many of those transports or all those transports. Financials, with yields rising, the spread usually, the yield curve normally goes up. And that is good for banks. And I audited banks for many years, so I understand that relationship pretty well. Anyway, and mostly it's more due to the spread, actually, the yield spread between longer term maturities and short term maturities, because that's how banks price out their products, in terms of their loans and then their deposits. Anyhow, that's a discussion for another day. What I wanted to point out, though, is that as we're moving up here, notice what's going on with industrials and with transports. They're not going up on a relative basis. They're going down while the yield's going up. What the heck's going on? Isn't this telling us that the economy is going to be stronger, which should be good for industrials, should be good for transports? I don't think that's what it's telling us. I think what it's telling us is people are getting out of bonds because of inflation. Inflation, not the economy, not the strong economy. And that is one of those puzzle pieces that tells me to be careful. Just this simple little relationship. When I see the yield going up, I should be seeing financials going up on a relative basis. I should see industrials which, by the way, they were going up. They started to turn right back down again last week. Even with the move up to new highs in the yield, we broke to a new month low in industrials relative to the S&P 500. And we're not that far from a 52-week low, even though we're at a 52-week high on the 10-year Treasury yield. What the heck is going on? Transports moving lower on a relative basis. They're underperforming the S&P 500. The whole time here, you can see over the last 2 months, yields have been going up. What the heck is going on? Why isn't it following suit like it was earlier in the year? What's changed? I don't think a whole lot's changed. I just think that there are a lot more folks now that the Fed has come out and said, oh, forget about transitory. Now we got inflation to deal with, taking longer than we thought. We're going to have to be raising rates. Well, you got a lot of folks repositioning their portfolios and a lot of folks selling bonds, getting out of bonds. You don't want to be in bonds during an inflationary environment because these yields are fixed. So as inflation goes up, you're just sitting there losing more and more money. So you don't want to be sitting in bonds unless they're inflation protected, and the 10-year Treasury yield is not. Anyway, so this is a warning sign to me. This is what's going on. I don't understand why financials are the only one of these three that really have been performing. I mean, and even financials haven't broken out to a new 52-week high. They're going up over the last month, but they haven't broken out. So there's still even a little bit of a disconnect there. All of that, I think, is important to keep in mind. All right, let's move on. Take a look at the S&P 500. Here's the S&P on the top. This is a 60-minute chart, so it's a 1 hour, 1 month chart. So this is only going back to last month. We bounced. Here was that January 24th low. Excuse me. Notice the bounce here on the S&P. Here was that January 24th low. This is the NASDAQ versus the S&P. Large cap growth versus large cap value. Mid cap growth versus mid cap value. Small cap growth versus small cap value. Notice that as the S&P 500 bottomed and put in a higher bottom a few days later, see how the NASDAQ on a relative basis just kept going further and further down. So did the growth stocks. This was kind of not a great rally. This is a very, very weak rally. Well, the good news is we had a little bit stronger rally finally. We got to move up, and this time we saw relative performance that was better. It wasn't great, but it was better. But as we turned back down, and even as we put in that last high back on Wednesday of last week, notice this high right here. See, clearly higher than the prior couple of days. The NASDAQ underperformed that day. Large cap growth underperformed. Mid cap growth underperformed. Small cap growth underperformed. They all ran out of steam. Prices kept going up. So the S&P is telling you one thing. The under the surface signals are telling you another. And look what happened at the end of the week, went back down again. So here's the thing. If we go back up and we get through 4,600, we've got to see these charts turning back up and setting new highs. If we don't, I wouldn't be trusting the rally at all. And even if we do, I still have other issues that we're still trying to deal with in the market, namely sentiment. So I'm still going to be kind of sitting on the edge of my seat and just waiting for the other shoe to drop. And maybe that other shoe is Thursday morning when we get the CPI. I don't know. But anyway, a lot of things to think about there. I have a similar chart to this, well, a little bit different, that I put in the weekly portfolio report to members on Sunday. If you didn't look at that, you should go down and look at it. At the very bottom, when I always do the summary of the market, the outlook kind of a thing, it was a much longer than normal dissertation that I went through. So if you are a member of Earnings Beats, make sure you go back and read that, because there's one particular chart that I put in there that tells me this rally is not going to last. So anyway, make sure you check that out if you haven't already. All right, next up, let's take a look at these sectors relative to the S&P 500. So what I have here is the XLK, just on an absolute basis. You can see it down there, challenging that neckline. Here's the right shoulder rolling back over, very similar to the S&P. There's the AD line, which still hasn't broken down. We actually still are holding on to that early December low. And then we've got relative to the S&P. And this is where things started to turn at the end of the month. See how we broke out to that last final hurrah, last final all-time high on the S&P at the end of December? Well, notice technology did not support that final move. That was a problem. I'm just going to show you a couple of these so we can move on to earnings. But here's the XLY. So here's the XLY on an absolute basis. Look at the relative. Remember, end of December, I just showed you S&P 500, last hurrah, all-time high. Look at where we were on the XLY versus the S&P 500. When these aggressive groups, market's still going up, but the aggressive groups aren't leading, that's telling us Wall Street is moving money out of these aggressive groups. You know, with sentiment already being an issue, this was kind of like a final straw. I mean, these are a couple of big issues. You know, you want to see aggressive areas lift the market. The last thing I'll show you here is, let me pull this up. The XLY XLP ratio. And so this is just looking at consumer discretionary versus consumer staples. Normally, this is like my favorite sustainability ratio. You know, when the market's going up and this is going up with it, I feel really confident that the market's going to keep going. But look at what happened in December to this ratio. It got torched. In other words, money was rotating very swiftly away from consumer discretionary and into consumer staples as we're setting a new 52-week and all-time high on the S&P 500. Why? Why would you want to go into consumer staples when you're breaking out to an all-time high? Well, ask the Wall Street firms, because they were doing it right before the January swoon. Telling you, the charts is where the truth is, not on CNBC and not all these media places. You've got to follow not just the charts, not just the S&P 500. You got to dig and you got to understand intermarket relationships. I give John Murphy a lot of credit because I feel like he was the pioneer in, you know, his books. If you haven't read his books, go to Stock Chart Store and order them up. Technical Analysis of Financial Markets. I mean, that is that's my stock market Bible. I still refer to it occasionally. I've read it multiple times. I feel like this is the key to really understanding the stock market. Not listening to, oh my God, inflation is going to be horrible. Oh my God, our debt's going up through, or, you know, they're raising the debt ceiling. They're so irresponsible in our government, blah, blah, blah. I don't listen to any of that crap, to be honest. That's just stuff that's fluff. And some of you might be saying, hey, it's not fluff. You know, we're going to have a spiraling debt. It's got to come, the cards are going to come crashing down. Yeah, they might. And you know what? I'm going to see it on the charts before it happens. I'm following the charts. So anyhow, yeah, right now, I mean, look at this XLY, XLP. How can I get excited about the rally we had last week? I can't. I need to see a whole lot more than what we're seeing so far in the early part of 2022. All right, earnings, they're going to be a bunch of them coming out this week. Now, we've had a lot of the big ones already report, but we're getting a lot more of the second tier. Many of those, you know, 30 to 50, 60, 70 billion dollar semiconductor and software companies, those types of companies, many of them are going to be reporting here over the next couple of weeks. So get ready. Like I said, a lot of companies going to be reporting. Anyway, Tyson Foods came out this morning. They had a pretty nice beat. Let me see if I can get that number for you. They were expected to earn $1.90. They came in at $2.87. And when I look at, you know, TSN, look at the stock relative to the food products group. It's one of the leaders. Look at food products group relative to the S&P 500. So here it's telling us this over the last 2 months. Remember when I was showing you XLY, XLP, that ratio going down, money's been going into staples. This is one of the staples areas, food products. Last 2 months, it's on fire relative to the S&P. And Tyson has been one of the best companies. And now this morning, shocker, Tyson's comes out with an earnings report that shows a beat of 50% over expectation. Now, it's already been going up. I suspect it's going to probably go up higher, but let's see what it's doing in the pre-market. And about 20 seconds we open here. Up $7 pre-market. Now, I do tend to say, you know, be careful about market reactions. I mean, just because a stock looks good on the chart doesn't always translate into a move to the upside. But in the case of Tyson, I actually wrote about another one of these. I think it was in this morning's EB Digest. When you get a move up that's showing this kind of relative strength, I think Wall Street's moving into a company like this. And look at it, it did pull back heading into its earnings. So I think that does sometimes give us a chance for a potential push. And I think there's another one coming up after the bell. Yeah, the one I wrote about in the Earnings Beats Digest this morning, I'll give it to you. But if you're not an Earnings Beats Digest subscriber, it's free. There's no credit card required. You should be a part of it. Go back to earningsbeats.com and you'll see it on that landing page. There'll be a place where you can sign up. Anyway, SPG, Simon Property Group. This is one that went up, and you can see was a huge relative winner in the among the REITs. And you can see the REITs have continued to perform pretty well versus the S&P 500. But now Simon's kind of gone sideways and hasn't really been doing much. I think they're going to have a good report, just my opinion. I think they'll have a good report, and I wouldn't be surprised to see the stock make a move back to the upside. 170 down the road, I think, is very doable on Simon. To the downside, I'd be careful, 135 to 140. I think that's a really key. There's your tops over here around 135. Here was a recent low, 140. So I'm thinking right in that area. I want to hold to the downside, but I would expect that we're going to go higher. They report after the bell today, and right now they're up $1.12 for today. Let's take a quick look at the market. I do want to wrap this up. I'll give you 3 other companies that will be reporting. I'll give you those for the 3 you must see in just a second. NASDAQ up 25, S&P up 13, or excuse me, S&P up 5, Dow up 28. And you can see percentages, all of them below 0.2%. Mid-cap's getting a little bit more of a push to the upside. Look at the VIX. VIX is up. Everything's green. The VIX is up a little bit today. Now, I don't usually make that much out of that from an intraday standpoint, especially right after the market open. But I just want to highlight the VIX is 23. When we're in a secular bull market advance, and it's truly a mature secular bull market, we're going to see that VIX down close to 10. We haven't even come close to that. That's why I think we still have a long way to go to the upside. It's just the short term. I'm saying 3 to 6 months that we have to be careful in the market. I think that is where we're going to be looking for this potential cyclical bear market. You know, I kind of feel like a weather forecaster that is trying to predict a tornado and saying, well, this area, you know, has a 30% chance. This area, this whole area, has maybe a 3 in 10 chance of spotting a twister. Well, that's kind of when you do stock market analysis, use intermarket relationship and all this, that's what you're doing, really. It's just like some days I really believe there's 0% chance of a tornado, most days. And that's the way I think in the stock market. I think there is a 0% chance that we're going to be starting a bear market. I don't believe that right now. I think that 30%, 40%, something like that, maybe even 60%, that makes more sense to me. Just understand the conditions are ripe for a market tornado. And we've already seen some of that in January. All right, let's take a look. Last 3 charts I'll show you real quick. Amgen reports after the close today. So let's pull this up on a relative basis, see if we're getting any clues. AD lines come up the last 2 months. Stock's been moving up, and actually it's been a pretty good performer relative to biotechs. Biotechs themselves, not so great, but Amgen has been doing better. It's at the 50-day. My guess is it probably bounces off the 50-day. So I think they beat. I don't know if they get a big jump. Amgen's kind of a giant, doesn't really move as fast as some others. I wouldn't be surprised, though, to see Amgen up with its earnings report. Let's see, another one. How about Tenet Healthcare? THC reports after the close today. AD line right here at about a 4 or 5 month high. So that's good. Moving up sideways, consolidating. That's pretty good compared to what the market's been doing. It's not been too far from a 52-week high relative to its peers. And its peers are moving up. Just recently set about an 8 or 9 month relative high. So I think overall, I think the stock looks pretty good. Volume's been coming in and the AD line's been going up with that. So I'm thinking that maybe we get a good report here as well. And let's see if we can find one other one. How about TDC? This is Teradata. This will be your final 3F3 you must see. Now this one, you got the AD line moving down. The TDC chart, price chart here for the last 3 months, moving down. You can see relative to its peers, down near a 52-week low. Its peers are starting to strengthen a little bit, but it's still, more closer. It's down closer to its bottom, 52-week bottom, than to its 50-week, 2-week top. So I think all in all, this one looks like a pretty bad one. So if I go into tonight's reports, and again, this is not any guarantee, but I'm thinking Amgen, probably a good report. Tenet Healthcare, probably a good report. And Teradata, TDC, not so much. I would be a little. So if you're asking me, would I be holding any of these stocks into earnings? TDC, I would not. I would be really worried about that report just based on how it's trading. The other two, again, I don't like to hold. I'm a trader. I'm not buy and holder. So you have to understand where I'm coming from, my perspective. So I tend to not hold. If I was going to hold, if I had a good position in Amgen, I've been making money for a couple of months, maybe I hold a third of it. Maybe. It just depends. I don't even want to commit because I don't know what I would do. I do tend to stay out of stocks for their earnings reports. But anyway, let's see how they close after the bell, see what happens with their earnings reports. All right, that's it for me. Again, one last check. Let's wrap this thing up. NASDAQ showing a little bit of strength on a relative basis, so that's good. And then let's take a look at the bonds. Bonds, 10-year, still at 1.92%. I don't know. We'll see whether or not we can get some push to the upside. Apple, you can see right there, up fractionally. Microsoft up fractionally, so that's giving a little bit of help to the Dow. Not enough, though, right now. As I said, Dow, on a relative basis, lagging. It is flat so far today. All right, that's it. I'll be back tomorrow over at Stock Charts TV right here. You can click there at 9 a.m. and listen to my next episode of Trading Places Live. Everybody have a great day. Remember, sign up for that Saturday event coming up this week. You won't regret it. And it's free. We have a free 30-day trial, which gets you into those next two events. Anyway, have a great day, everybody. Happy trading.